Hi. Let me first apologize for being completely absent for months. I know, I have no valid excuses, so I won't bother explaining myself, other than to say I'm going to endeavor to publish more videos more often going forward. Now, I may need to do some experimenting with format in order to do that, but for now, let's get right back into the series, and I hope you'll continue to be a subscriber and give me another chance. Pretty please. Now, from the last video, we now understand the two main types of investments: equity versus debt. And remember, these have multiple names that people use interchangeably, like stocks and ownership, and fixed income and bonds. Now, we're going to introduce a working definition of what a portfolio is. But I want to make clear that we'll be spending more time on portfolios in future videos in this series as well. There is a lot to cover. So in reality, this video should be called something like Learn About Investing Part 7, subtitle Portfolios Part 1. Hopefully you're here for the content and not the genius marketing and branding of said content. For now, all we need to know is that portfolio is simply a word used to refer to all the investments you hold. That's it. So if you had an investment account and inside this account held 30 different stocks, well, that is your portfolio. If you held stock in 50 different companies and owned 20 different bonds on top of that, well then all of that together is your portfolio. And if all you held was one stock, then that is your portfolio. So really, portfolio is just a fancy sounding word. Think of it like an artist's portfolio of photos or paintings. Their portfolio is just all of their work. Your portfolio is all of your investments together in an account. That's it. So one thing you need to know about the world of finance and investing is that it kind of goes out of its way to confuse the out of you unnecessarily. So always keep that in mind. Now, when it comes to managing your portfolio, that's what's really of interest to us. So let's start to break down the different parts of portfolio management, which again, is just a fancy way of saying, let's talk about how we pick the investments that go into your portfolio and how we manage them over time to meet your end goals. That is essentially what portfolio management means. Sounds like an impressive phrase, but it's really quite simple. So, remember from the last video, we talked about the difference between stocks and bonds in general. One is a form of ownership or equity, and the other is debt or fixed income. Well, equity and fixed income are two different asset classes. So let's first define asset class, which will then allow us to explain the concept of asset allocation, which is probably one of the most important aspects of managing your portfolio that there is. Okay, so what is the definition of asset class? An asset class refers to investments that generally behave in a similar way. That's pretty much it, but probably deserves a little bit more explanation. If we look at stocks versus bonds, we know that the overall risk and return potential from the last video is generally quite a bit higher for stocks than bonds in general. So equities are an asset class, and fixed income is an asset class too. Now, equities and fixed income are the major top-level asset classes. And before we get too deep in the various subtypes of asset classes that exist, which we'll get into in future videos, let's dive right now into the concept of asset allocation, because this really is the most important part of portfolio management. Asset allocation refers to the proportion of asset classes in your portfolio. And what's really important about this is that these proportions will dictate how much risk and potential return your portfolio will exhibit. So let's start with two extreme examples. You could have a portfolio that is 100% equity. It's all stock. That portfolio is going to have a lot of risk and a high potential return. The asset allocation of that portfolio is 100% equity. On the other extreme, you could have a portfolio that is 100% fixed income. It's all bonds. That portfolio is generally going to look pretty pedestrian in comparison. It's going to be low risk and low return in general. Now, the asset allocation of this portfolio is 100% fixed income. So here's a crucial point to people who are new to investing. I know a lot of people who see investing as this sort of binary option, where if you don't invest, you get the low returns of a bank account. But if you do invest, you have to face the full swings of the stock market, which can be scary. So that's not true at all. It is not this binary choice. And this is where asset allocation comes into play. By adjusting the ratio of equity to fixed income, you can dial in the level of risk and potential return that is appropriate for you. So if you only wanted the potential of a slightly higher return than a bank account and correspondingly just a little bit of risk, you could do that. You could have a portfolio that is 20% equity and 80% fixed income. Or if you could stomach a bit more risk, you could have a portfolio that's 40% equity and 60% fixed income, and so on. So now is a good point to discuss some lingo that you should become familiar with. When we are talking about this top-level asset allocation, the ratio of stocks to bonds, which is often referred to as the ratio of equity to fixed income, you'll hear people use phrases like this. I've got a 60-40 portfolio, or I've got an 80-20 portfolio. Generally speaking, the first number refers to the percentage of equities, and the second number refers to the percentage of fixed income. So a 60-40 portfolio would be 60% equity and 40% fixed income. An 80-20 portfolio would be 80% equity and 20% fixed income. So the asset classes are equities and fixed income. The asset allocation is the ratio of these two, which determines the overall level of risk and potential expected return of your portfolio. Don't forget to hit the like button if you made it this far and want to see more. In the next video, we're going to revisit the relationship between risk and return. Yes, we're going to do this often in this series. But now what we're going to do is we're going to combine that with various different asset allocations to give you a better idea as to how these two concepts are related, and is super important for investors to understand. If you're new here and haven't yet subscribed, make sure to do so, and I'll see you guys in the next video. When will that be, you ask? I'm not entirely sure, but I'm going to say within 7 days. Actually, no, within 14 days. I'll endeavor to get it out in 7 days, but realistically, it'll probably be 14. But it's definitely not going to be like 6 months like the last video. So thanks for your patience. See you in the next video.